Last year's and Wimpy-owner Famous Brands hiked its full-year dividend by more than 80%, reporting earnings that rose more than a third as it benefited from the lifting of COVID-19 restrictions that saw South Africans flocking back to restaurants. The company reported that its revenue rose 15%, while operating profit rose 37% to 861 million rand. For more, we are joined by Famous Brands CEO Darren Hele. Darren, thank you so much for your time. I mean, with an environment that has a constrained consumer as well as environmental challenges such as load shedding, low growth, etc. Let's look back at the year that was for Famous Brands. How would you characterize it?
Thanks very much for having me here. Yeah, I mean, a year that was obviously characterized by uncertainty as we have now, but certainly probably not as bad as what we have. I mean, we did have the tailwind of COVID recovery, as you've suggested, but there was still lots of turmoil, KZN floods, a few other macro factors that we had to deal with. But by and large, we saw a return of people to sit down restaurants and getting out and about. And that's really what we've benefited from. And not quite back to where we were before pre-COVID, but definitely seeing people getting out, meeting other people, family occasions, traveling, and hence the difference, to COVID levels.
Over the past few weeks, a lot of the JSE-listed CEOs, especially in their results, have highlighted the costs of load shedding and how much they're spending when it comes to running diesel generators. What kind of impact have you seen from a Famous Brands perspective locally when it has to do with load shedding?
Yeah, we're no different. I mean, our business model is slightly sort of different to the others that you may have seen with the big numbers, but the principle is the same. Our difference in diesel usage was up 957% this past year versus the previous year. And we've just announced today that we have been supporting our franchise partners for the last 2 months around a specific scheme around helping fund alternative power costs during load shedding periods when those sales are generated, if they're generated. So we're seeing the same, and we anticipate that, again, our diesel usage this year will go up significantly more than the past year, even if you look at the difference between H2 and H1. But, it's a lottery. We sit, March was quite horrific. April was better. May's been up and down. So unfortunately, there's just no predictability is really the biggest challenge.
With trading conditions remaining as they are, what kind of conversations are you having with your franchise partners, and what does it mean, I suppose, for attracting potential franchise partners in an environment that we find ourselves in?
We don't worry too much about attracting franchise partners. I mean, we have a value proposition. We're an ethical franchisor, and the food service market is growing. So that's probably the least of our worries. The conversation with existing franchisees, as you mentioned, are the most important, and how we tackle this together. It's a shared value model, and we can't be oblivious to the problems that they face, and we work through that all the time. I'm sure we get it wrong at times, and I'm sure there's times where we get it spot on, but we need to constantly work at it, and that's what we do. That's our role. We engage with them, and we provide solutions. And sometimes we've got to take the pain, and they're always taking the pain in terms of load shedding. So we have to try and work towards that. And every situation is unique. Some landlords have invested, so the alternative power is there. Others, there is no alternative power. We still have a percentage of restaurants that are not on any form of alternative power. So it's all I can say is we just continue to engage and work with our franchise partners. We don't have the solutions on load shedding, and neither do they, and I don't think there's anybody else there that does. So we just navigate what we've got to do, and I'm confident we'll get it right, but it's going to take time. And we do have experience of this in Africa. A lot of our restaurants are constantly running on alternative power in Africa, so we've become quite knowledgeable and hardened around these issues.
What kind of trends are you seeing when you look at consumer behavior when it comes to dining out or perhaps home dining?
Home dining continues to grow in terms of, where the meal is purchased out of home. So it's not necessarily, cooked from first principles at home. So we think that there's still a place for us in that market, and we continue to be a meal provider to people in their homes. We'd obviously prefer to get them out of their homes for a variety of reasons. Typically, they spend more when they're out of home. But we are seeing that trend is getting back to pre-COVID. The fundamental difference we're seeing is on night trade, where particularly in a place like Johannesburg or Gauteng, is that the evening occasion is a lot earlier. We're not seeing that later occasion coming back as it was pre-COVID, and I suspect that's around load shedding, potholes, security, probably more than anything else. But those are the fundamental trends we are seeing. But certainly lunchtime is offsetting some of that, and early dinner.
Let's talk a little bit about the UK market. I mean, we've seen low consumer confidence and spending. Are you starting to see a recovery come through when you look at the UK market?
No, I would say it's probably too early for that. I mean, the recovery post-COVID was there, but they've now got a whole new set of challenges. I mean, it's a very small part of our business, and we're very small in that market, but we still see the trends. I think there's still some sweat there. I mean, the March numbers on food inflation were quite horrific, so we think that there's still some pain to come through, hence us taking an impairment increasing our impairment at your end.
Going forward, before I let you go, what will you and the team be focusing on?
Look, I mean, there's a lot to distract us, but we've got to simply focus on, as you mentioned earlier, surprising and delighting consumers. If we're not, making their experiences not just value for money, but rememberable and enjoyable, then we're going to struggle. So we've just got to keep focused on that core. Despite all of this that's happening in the macro, we just got to make sure we're delivering, quality service, friendliness, and value. Those are the key parts of what we've got to do in a clean environment.
You opened 3 drive-through restaurants for 2023. What kind of future are you seeing in that space going into 2024? Is there scope for more?
Definitely, we are lacking in that part of the industry. So we, I suppose, have fallen behind a bit over time, and COVID really, made that sector more viable than what it is. So we've got some catch up to do. So yeah, 3 definitely is not the kind of number we want to be putting out there next year. We've got some work to do, and the opportunities are there. We've just been, we reacted to the economy in a certain way. The economy is changing, environment's changing, and drive-through is definitely getting a bigger slice of the action than it has historically.
And we spoke about that constrained consumer a little bit earlier on. What has been the feedback you've received since the launch of these 3 drive-throughs?
No, exactly that. People just flock to convenience. So that they like our product, and we just need to be making sure that we put it, where they are, what's convenient for them, and just making it easier for them to access us. And that's really what drive-through does. I mean, it creates a better sense of security. It's more convenient. So it's not our product. It's really just the accessibility that we've got to get, improved, and that has changed post-COVID.
All right, Darren, thank you so much for your time. That is Darren Hele, who is the CEO of Famous Brands, taking us through the company's financials.